Well, hello there, everybody. This is Morris from San Jose Options. You can find us at sjoptions.com. This will be a short tutorial on trading portfolio margin, which is an options trading account which margins are based on risk. You'll find that many of the brokers that offer portfolio margin are using a risk measuring model called the TIMS, which is brought to the industry from the Options Clearing Corporation. You can always go to their website and read more about it. The industry is allowed to use the TIMS, but they're not required to use the TIMS. So you'll find brokers moving away from the TIMS and applying their own risk models. In fact, you can have the exact trade, for example, at broker A, and then the same trade at broker B, and if you analyze the trades or execute the trades, they'll have an entirely different buying power effect on your account. So it's very important to understand that. As you trade a portfolio margin account, the risk models that your broker is using is crucial to your trading. It's of utmost importance to understand how it works, to know exactly what the formula is. We are experts on the TIMS formula, and we can teach it to you so that you thoroughly understand how this model works, how it calculates your margins, how to avoid some situations where if you do not understand the TIMS, you may actually find yourself without buying power in different situations, and you may get stuck with your trades and not be able to close them out or reduce risk or trade, and you may not understand why. So it's very important that you understand how the TIMS works, and we're here to teach you all about it. That being said, through the understanding of these different risk models that are being used at your various brokers, we're here to help steer you away from some potential problems that you might have. Again, such as losing your buying power instantly that could happen if you do have a portfolio margin account. We're going to teach you how to benefit from portfolio margin trading. Again, once you understand exactly how these risk models work, like the TIMS, for example, then you can benefit from it. Okay, there's pros and cons to that risk model, and we'll show you the pros and the cons. Will explain to you how to avoid, again, potential hazardous situations and how to profit and better position your portfolios. Now, before you do get into portfolio margin trading, you will be required to pass an exam at most of the brokers. But I also encourage you to ask that broker for their risk model, and it's very important because as we have seen, and we've gone from broker to broker to see their formulas, they typically have something different. And these different formulas are going to create different buying power calculations for your particular trading style. So you want to make sure that you understand what the risk model is, and then test your strategy on that risk model and see how they work together. Make sure that you can always reduce risk, make sure you can always exit your trades, and do some back testing and see how accurate those risk models are. You may ask your broker how the risk model treats directional changes, how that risk model treats volatility changes. Ask your broker to give you an example of how they're going to calculate margins on your trades. Ask them how they're going to calculate margins as you go into expiration as well. For example, 1 day out or 5 minutes, your margin may change when your trades expire. And how is that margin going to change? Make sure you understand. There could be a situation, for example, where your margin is fine, and then as soon as some trades expire, your margin goes through the roof, and then your account gets liquidated. So these are things that you really have to understand if you're going to trade portfolio margin. You also want to ask your broker if they have more than one risk model. This is also crucial because there's some brokers that have multiple risk models, and as the market changes and maybe volatility increases, they may change that risk model on you on the fly without any warning. And again, you may have plenty of margin one day, and then the next day all of your margin is gone and you get a margin call. So those are some of the basics about portfolio margin trading that every trader must know before you start to trade a portfolio margin account. So I hope you've enjoyed this video and picked up a couple tips from SJ Options. Please give us a call at 800-862-2503 and just mention this short video and we'll give you 10% off your membership. Thank you once again. Hope you learned some great tips here at San Jose Options, and we'll talk to you soon.